We're going to take a look at an IUL policy that's been around since 2009, see where it is today at the end of 2025, and see this client has been taking loans and withdrawals out of the policy and is going to continue for years to come. So we're going to take a look at an IUL and say, okay, where did we start? Where are we at now? What does it look like right now? What does it look like going forward from here on? So stay tuned, we're going to get into it. Hi, my name is Aaron Andrew, and we're going to take a look at this policy that's been around since 2009. This is a client of mine that's been around since 2009. We opened up this policy, put a bunch of money in. We're going to take a look here at the screen now, and we're going to take a look and see just a snapshot of where it's at. So this statement right here is an annual statement. So this one right here is an annual statement that's been around or that we just got back in August of this year of 2025 at the time of this recording. And looking at this contract, this client, if they were to pass away, the death benefit right now is currently $1.4 million. That's the death benefit of what they would get. They currently have an accumulation value of $1,087,000, you can see. And so they got $1,087,000. They got $1,087,000 in the surrender value. There's no what we call surrender charge. There's a penalty or a surrender charge for the first 10 years in most policies, 10 to 15 years, depending on the company, okay? But basically in this IUL, they've been growing money tax-free, tax-deferred, being able to take it out tax-free, and when they die, it's going to transfer tax-free. So hopefully you've watched a bunch of other videos. You have a foundation on IUL, but we get a lot of people that say, you know, I haven't seen an IUL, or I want to see one that's been around for a while and what it's doing. So again, this has been around since 2009. You can see their average interest rate has been 6.66% since the beginning of the policy. So they've had some money in the fixed account, you know, not too long. They don't have anything in there right now. Their 1 year in S&P account has averaged about 6.5. That's where they have most of the money right now. They still have some money in this international account that's averaged about 5.35. Not quite as good, but still okay. And then the 5 years, okay? So they've been more conservative, gone more to the 1 year account. So every client's gonna be a little different of what the average returns are. Some are gonna be averaging 10, 11, 12%. Some are gonna be averaging 6, 7%, depending. You'll see a bunch of videos like this of different returns based upon which index accounts they were in. If they wanted to be more conservative or be a little bit more long-term or more aggressive, because you can see back when they had money in this 5 year account, they don't have any money in it now, but they averaged 12.65% when they were in that one. And this other high par 5 year account, they've averaged 12% since they've been in that account since 2009. And that has 123,000 in it, about 11% of their funds. So yeah, out of this million one almost that they have in cash value, these are the returns that they've averaged in each of those index accounts. So this company is pretty cool where it shows that right here. So their overall average return has been 6.6 since they started it. And here's where their allocation is in the different accounts. Now, this past year, from August of 2024 to August of 2025, the policy had about $1 million in it, just about there. And this client's been taking out withdrawals. So some companies, okay, or some clients, excuse me, might be taking out withdrawals to basis. All right. So if you read inside the Laser Fund book, read chapter 8, where we talk about here in the book about the smart way, the sad way, and the dumb way to get your money out of an IUL. But one of the smart ways is, of course, the main smart way is to take out loans. But some of the older policies, if they've been around a while and you're 15 years plus into the policy, which this client is, they opened it in 2009, we can take out withdrawals to basis if we want. And it works a little bit better if we do that. So we do withdrawals to basis. So you can see the client this last year, they took out 40 grand last year. They took out a withdrawal of 40,000, not a loan, but we're going to take out withdrawals of 40,000 until they've taken out their basis. Then they're going to switch to loans after that and take loans from then on. All right. And the loan they're going to take, they're going to borrow at 2.25%. So you're going to borrow at 2.25%, and the cash value they're borrowing against is going to earn 2.25%. So it's called a zero wash loan or a zero cost loan. All right. So in this example, this last year, you can see they earned $129,000 of interest, and they only had about $1,700 drain out in fees and expenses. Pretty cool. All right. So you look at this, people say, oh, these things are expensive, especially when you get older. No, this client is in retirement. They're in their 70s, and the fees. And what is that paying for? The difference between $1,087,000 and $1,392,000, the difference between those two is what we call the net amount at risk, okay? It's about 300 grand. So it's about $300,000 is the amount of insurance risk they have. This is important to understand. The $1,087,000 is their own money. So they pass away, you don't get both the cash value of $1,087,000 and the death benefit of $1.4 million. You get just the death benefit. And some people say, oh, that's cheating you. They're keeping all your money. It's like, no, you need to understand you're only paying for the net amount at risk. We're only paying for 300 grand of insurance. So at this age, in their 70s, $300,000 of, well, let's see here. Actually, they are, might be wrong on their age. So, excuse me, they are 62. So right now, they are, I was mixing them up with someone else. So they're 62 years old, and they've been in the policy those 17 years. So this is actually an in-force illustration we're going to see in a second, where you see they're taking out $40,000 a year is what we are projecting, is what they wanted to take out of this policy. So we'll come back to this in a second. But going back, he's 62 years old. The cost of insurance is costing about $1,700 for about 300 grand of insurance at age 62. So they retired pretty young. Okay, they've been taking money out of this for a few years now, and 17 years into the policy. So if they passed away today, the death benefit would pay out $1.4 million. All right, again, why doesn't it pay out both numbers? Because this is a level death benefit, and the cash value is part of the insurance, and that way it's their own money. So they're not paying for $1.4 million of insurance, they're paying for 300 grand of insurance. All right, so you can see here, I just mentioned the standard loan down here in the bottom. That is the rate of 2.25. So if they decide to take loans, they borrow at 2.25, and then the collateral, they took out 40 grand in a loan, 40,000 of their accumulation value would earn 2.25. All right. You can see right now, they've been earning some good returns, good solid policy, low cost. It's doing great. Let's look at the in-force illustration here. So again, 129,000 of interest this last year. Actually, let's go back and take a look at that. They had some, I think, some 5-year accounts that matured. So let's see which accounts matured. Yeah, they had some, check this out. They had some accounts earning 7.5% this last year and back up to 8%. So they had some earn 8, some earned 7.5 this past year, but they had some 5-year accounts mature. So from 2019, excuse me, 2019 to August of 2024, this is a year ago, that 44,000 earned 83,000 or 83%, excuse me. So that was $36,000 of interest credited. All right. Now, the other account, this smaller one, they had some money also in May of 2020 to May of 2025. And that return was 111% over 5 years. So you can see the 5-year is crazy good. You get all the growth with no cap. So in this account, on that $19,000 over 5 years, they earned 22 grand of interest. Pretty cool. So they earned 22,000 of interest and 36,000 of interest on that. So 83% and 111% over a 5-year period. They had to wait 5 years, but over that 5-year period, they earned crazy high returns. That's why, if we go back here, the 5-year account is showing annualized average returns of 12.65 and 11.97, those high returns. And so now, of course, they look at hindsight, they wish they would have kept more money in the 5-year, but they wanted to be more conservative and have a bunch of money in the 1-year accounts. So let's go back here and let's look at what we call an in-force illustration. So this is a projection now of saying, all right, looking at this illustration, if we only earn a very conservative return of 5, you saw that their 5-year accounts are averaging like 11, 12%. Their 1-year accounts are averaging more in the 6% range. So, and they've averaged 6.6 because of that over the life of the policy. But if we only earn 5% on average in these accounts mainly, what would this thing look like going forward? So again, this is very conservative, could look better. But what we're doing is we're taking out $40,000 a year tax-free all the way down here to age, I think we went to age 90 in this example. Yeah, to age 90, okay? So in this example though, you can see that we're gonna take out withdrawals that we might take out a loan this year, 40, but here we're taking out withdrawals all the way down until we've taken out their basis. Then we're gonna switch over to loans in this company, okay? Now, this older policy doesn't have some of the cool features that some of the newer policies have. So this policy doesn't have the loan option called an index loan or participating loan, where we borrow at 5% and our money can keep earning the index returns, borrow at 4 or 5 and your money and the collateral stays in the index. This one has just the zero wash loan. That's why we're taking out withdrawals to basis, withdrawing what we put in, and then taking out loans. You can see, projecting the cash value going forward, that they only want to take out $40,000. So this conservative 5% projection that the government will allow us to run, you can see here that the account value is growing. Look at the net surrender value. Let's just zoom in here a little bit more. And you can see that the account value is growing, net of all fees and expenses. Anytime they pass away, This is the net surrender value, net of the loans or the money they've taken out. And the death benefit, column 7 over here, is also your what you would transfer tax-free if they were to pass away. And that includes the cash value. So once again, the difference between the net surrender value and the death benefit, that difference is what we call the net amount at risk. That's what you're being charged for insurance cost. Okay. And I'll show you the fees in a minute. So if we keep doing this, we go to age 90, for example, you can see all the way down here by age 90, they're going to have 1.8 million still left, and their family is going to get 1,980,000 if they pass away. Again, I can't emphasize this enough. I sound like a broken record, but they're not going to get both. If you wanted both the 1.9 and the 1.8 million, both on top of each other, you'd be paying a lot more in fees. Let's take a look at the fees. If we scroll down here now, let's go down and look at the fees and expenses. So this is projecting the fees. So you can see here, the client is paying no more premiums. All right. They've been in this policy. They're in the 17th year right now. Age 62. They're not paying any more in. So there's no more what we call a premium load. The admin fee is $90 a year. This fee went for 10 years and went away. The column 4 called the coverage charge. And the cost of insurance is the only thing we're dealing with. By the way, they say non-guaranteed. Yes, they can change the fees and expenses. This company never has. They've actually lowered their cost of insurance and fees for clients. So basically, in this example, our annual fees, I mean, you guys know we got about $1 million in there. We scroll over here to the right and you can see this. Our fees are costing us about $1,000, almost $2,000 a year. And they got $1 million in there. Okay, if this was in a money managed account, they would be charged on average about 1%, which would be about 10 grand in fees. Okay. Plus they'd be volatile in the stock market. They wanted this money more safe and conservative. That's why they're in that 1-year index account. And this money's coming out tax-free. They're paying no taxes on the gains on the policy, no income taxes when they pass away. So pretty cool. All this money is coming in tax-free. All the interest, of course. There's nothing that they're paying taxes on. So you see the costs and the fees are very, very low for how much money we got in there. You know, we got $1 million, and you go down to the next. Let's go down to, life expectancy here. Let's go down to age 90. So age 90 is where the fees kind of peak. You can see the fees are up to about $7,000 now, $6,900. But we're earning about $100,000 in interest on this conservative, illustration. Okay. We've got $1.8 million in the policy. The cash value is the same. The death benefit's a little higher. That's why there's about $7,000 in fees, because the death benefit's a little bit higher. And the fees even go down here as you get into, above 90 here. Okay. So we just stopped the income at age 90. You could keep going, of course, because you've got almost $2 million in the account now. So this is an awesome example of a client that is conservative. They don't need to take out too much. They're taking out $40,000 a year, way less than they could. They could take out more, taking out $40,000 and still leaving behind a bunch of money. Stay tuned and watch some other videos, and I'll show some that have the account depleting where we're taking out more, others where we're not taking out anything. But pretty cool to see an example of a policy that's been around since 2009 and that has now been for years taking out $40,000 a year and are going to continue. And with a conservative projection, projecting it forward in the future, called an in-force illustration, what it will look like. So if you have an IUL, you can take a look at this. We do this all the time where we a policy, a client that set him up with somebody else, and we look at it and make sure it's designed correctly, make sure it's performing correctly, do an in-force illustration to see what does the policy look like going forward, because we need to see what that looks like by taking out the $40,000 and how long it could last and so forth. So thanks for watching, and stay tuned to the next one, and we'll get into more. And if you want to learn more, make sure you go to laserfund.com, order your free book. All you got to do is pay for shipping. And we got so many details in the book, and contact us and we could show you setting up a policy like this for you. Thanks for watching.